Welcome to another video on management accounting by Debit and Credit Online Classroom. In today's video, we'll be discussing about the difference between financial accounting, cost accounting, and management accounting, limitations of management accounting, and recent trends in management reporting. We have studied the financial accounting as well as the management accounting definitions and meaning. Let us differentiate the financial accounting and the management accounting. When we consider the users, the financial accounting is used more by the external persons to take financial decisions. That is, the stakeholders are the external stakeholders are the financial institutions, trade unions, government, etc. But in the case of management accounting, it is for the managers to plan and control an organization. More importance is for the internal stakeholders. The time focus, financial accounting, it is having a historical perspective, but the managerial accounting is having a future emphasis. That is, the decisions for the future is taken on the reports given by the management accountant, and the plans are made based on these reports. Verifiability versus relevance. Financial accounting emphasizes on verifiability, but managerial accounting emphasizes on relevance for planning and control. Precision versus timeliness. Financial accounting emphasizes on precision, but managerial accounting emphasizes on timeliness. Primary focus of financial accounting is on the whole organization, how it is performing and all. But the managerial accounting focus on segments of an organization. It is for the planning and decision making of the by the management. Financial accounting must follow generally accepted accounting principles and prescribed formats, but the managerial accounting need not follow the gap or any prescribed format. It is made according to the requirement by the managers. The requirement of financial accounting, it is mandatory for external reports, but managerial accounting, it's not that much mandatory. These are the main difference between the financial accounting and management accounting. Management accounting emphasize on the reports which are made from the financial accounting to make future plans and decisions. Now let us discuss about the difference between cost accounting and management accounting. Cost accounting has limited scope to provide cost information for managerial uses, but the management accounting has a broader scope as it provides all types of informations. Cost accounting emphasizes mainly on cost ascertainment and cost control to ensure maximum profit, but management accounting is mainly on planning, controlling, decision making to maximize profit. Cost accounting techniques are standard costing and variance analysis, marginal costing and cost volume profit analysis, budgetary control, uniform costing, etc. Management accounting, all the techniques of cost accounting, but in addition, it also uses ratio analysis, fund flow statements, statistical analysis, operation research, mathematics, economics, etc. whatsoever help management in task. Evaluation. Cost accounting, its evaluation is mainly due to the limitations of financial accounting. Management accounting's evaluation is due to the limitations of cost accounting. Statutory requirements. Cost accounting, maintenance of cost records has been made compulsory in selected industries as notified by the government from time to time. It is purely voluntary and its use depends upon the utility of the management. Now let us discuss about the limitations of management accounting. As the management accounting is based on financial and cost records, the accuracy and validity of management account is largely based on the accuracy of financial and cost records maintained. If any mistakes are then there in these financial and cost records, it will be reflected on the management accounting also. The analysis and interpretation of financial statements are fully depending upon the capability of the analyst and the interpreter. Hence, personal prejudices and bias of an individual can affect the objectivity and effectiveness of the conclusions and recommendations. So, it is purely based upon the person who interprets and analyzes it. Lack of knowledge and understanding of the related subjects. Financial accounting, cost accounting, statistics, economics, psychology, and sociology are the related subjects of management accounting. The organization can derive more benefits of management accounting if the management accountant has thorough knowledge over related subjects. If not so, the success of management accounting system is questionable. Provides only data. Under management accounting system, many alternatives are developed to solve a problem and submitted before the management. Out of the many alternatives available, the management can select any one of the alternatives or even discard all of them. Hence, management accounting can only provide data and not prescribe any course of action. Scientific decisions can be taken with the help of using management accounting techniques, but majority of the management accountant and top level executives prefer their past experience and intuition in making business decisions. The reason is that intuitive decision making is very simple and easy. That is, these managers, they will decide from their past experiences without analyzing or interpreting the data given to them. So again, this will affect the decisions. And the installation of management accounting system is very costly. Hence, a small business organization cannot bear the cost of such installation. Moreover, the utility of this system is restricted only to big and complex organizations. Resistance to change. It is the man's nature that accepting the changes is very difficult, and this will affect the management also. The installation of management accounting system brings some changes in the organization setup and accounting practice. Persons concerned may resist such changes unless they are getting confidence. One of the major function of management accounting is analyzing, interpreting and reporting to the management for decision taking. Reporting is the process of communicating of information to those who need such information relevant for decision making. Some of the recent trends in reporting are financial reporting using IFRS, International Financial Reporting Standards, that is the IFRS, is recognized as the global financial reporting standards. From 1st April 2011, Indian accounting standards were merged with the new IFRS. IFRS ensures more transparency, consistency and uniformity in accounting policies. Interim reporting. Usually the reports are made at the end of the accounting period, but the management needs reports in between also to make decisions. They are the interim reports. Interim reporting is the reporting of financial results of any period that is shorter than a fiscal year. SEBI guidelines require companies listed on stock exchanges to publish their financial results on quarterly basis. Segmental reporting. It is the reporting of the operation segments of a company in the disclosure accompanying financial statements. I think we have learned about the segmental reporting in class 12th. Especially the CBSE students, they were doing the projects on segmental analysis. So that is the segmental reporting. After the analyzing and interpreting, we have to report that to the management. That is the segmental reporting. AS 17 requires to report a segment if it has at least 10% of the revenue, 10% of the profit or loss, or 10% of the combined assets of the company. Corporate governance report. The SEBI regulates governance practices of companies listed on stock exchanges. These regulations are notified under Clause 49 of the listing agreements of stock exchanges. It prescribes the standards to be followed in the governance of the companies. Reporting of information relating to group companies. AS 21. AS 21 requires companies to prepare consolidated financial statements. It is the presentation of subsidiary companies. The objective of consolidation is to show the performance of the group as if it were a single entity. The intergroup transactions are eliminated in the consolidated financial statements. This is applicable to the group of companies. They will be having a lot of subsidiary companies, and according to the AS 21, the companies should prepare a consolidated financial statement as if it's a single company. I believe that with this video you have got an idea about the difference between financial accounting and management accounting, cost accounting and management accounting, the limitations of management accounting, and recent trends in management reporting. If you have not subscribed to my channel, please subscribe to today itself, now itself. Thank you for the support you are extending to me. In next video, we'll be discussing about the analysis and interpretation of financial statements. Thank you very much.